Hi everyone, my name is Mary Redmond. I'm talking about the US dollar Canadian dollar today. This is an interesting pair. It's a little different from most of the other currency pairs because it's lower volatility. Generally speaking, the average daily trading range is lower for the US CAD, and that's good because you can take higher positions with less margin. It's slightly less risk than there are in some of the other commodity pairs like the Australian New Zealand dollar, because this one is a little bit less likely to spiral up or down 200 pips in a day unless there's some really big news out. This is a pair that's been in a downward trend for a very long time, really for at least the last 2 years, and you can see on a monthly chart sometimes these trends can change with a really dramatic pivot point like the one that we saw here in 2007, and sometimes they can just gradually change. And this looks like this is a bullish engulfing candlestick right here, and the blue candlestick, the bullish one, is bigger than the red one, so that does look like it could be the beginning of a trend change, not necessarily a permanent one, but at least one that could last a few weeks or a few months. And you can also see that the downward channel, which was basically formed really during 2010, just this particular downward channel, which is a 6-month one. We did see a break to the upside here. It may not be necessarily as strong as a real bull would like to see, but you do see the beginning of the formation of a new upward channel. And however you like to look at this chart, you can see it in a number of different ways. You can see that as a channel. It crossed above its 50-day moving average. You can also see that there could be a reverse head and shoulders here, or even a cup and handle pattern. And I do like the way it made a cross. It did make a bullish cross here when it hit a low of 94.50 basically. It made a bullish cross on the twin ARSIs that I like to use, and also the moving average convergence divergence indicator started to move up, so those are all bullish signals. But the US dollar Canadian dollar also responds very closely to oil prices, of course, because Canada is a big oil exporter and the US is one of their biggest customers, so you always want to keep an eye on oil prices when you're looking at this one. And if you look at the chart I have of the oil index, just the basic CBOE oil index, well, it took a big 10% move downward and moved down below its 50-day moving average in the last couple of weeks. And the US dollar Canadian dollar didn't really respond as much as it could have to that. You can also take a look at a point and figure chart, which I sometimes use for the oil index, and that really looks pretty bearish. That has an objective of 745 for this point and figure. This is called a low pole reversal, and it looks like a head and shoulders top too, so that could be having some impact on that. But you also want to remember that the reason this is partly the reason the US dollar Canadian dollar's been in a downward trend is because of the Bank of Canada, and they've been hiking interest rates. And the Canadian Central Bank is very concerned about inflation. You can see it right here on their website. It's the first thing they say. I mean, they want to keep inflation low and stable. And in the last report in March, the headline inflation was 3.3%. That was somewhat above their target. That was reported in April. The core inflation was 1.6%. So there's not a definitive answer whether or not the Bank of Canada is going to be raising rates in the next 6 to 12 months. The market is still pricing in rate hikes over the next 12 months, but when Mr. Carney spoke at the last Bank of Canada meeting, he simply said that rate hikes must be carefully considered. And he did give a speech last week which said that there may be less need for interest rate changes this year than there was last year. So, you know, he's not committing to anything. He's kind of leaving himself open and saying they're going to respond to whatever develops, whether it's inflation or good economic growth or bad economic growth. But, you know, Canada is, as with a lot of other countries, it's going to be impacted by what happens with the European issues. And of course, this week we had a lot of news come out with the situation in Greece, and of course there were multiple downgrades of the Greece's credit rating, and there's a lot of political and economic divisions in the EU. And the worst thing that could happen for a small country is to have the credit spreads start to spike up again. And so far that hasn't really happened. I mean, the EU economic problems have really been contained to the smaller countries like Greece and Portugal. But, there is always a chance that it could start impacting the economic growth in some of the bigger countries, and that could impact oil prices all around the world and credit spreads, and cause a tightening of credit and a lack of liquidity. So I'm sure that's something that the Bank of Canada is going to be keeping an eye on, as well as the other central banks. But for now, you've got the beginning of a little channel here upward, and I kind of like it on a pullback to possibly the 96.8 level. I don't know if this is going to be a permanent upward trend that's going to last for months or weeks. I don't think anybody knows that, which is why it's always important to pay attention on a day-by-day basis to what develops and what these central bankers are going to say. But I do think that for the moment the downward trend in the Canadian dollars is US dollar Canadian dollar pair may have abated, and I think that there's a good chance if it clears the parity level that we could see another good 200 to 300 pip trade.